Joe, it's been a while since we've done one of these market updates. How are things on your end, first of all?
Things are great. We're closing out the end of the year. It's been a really busy year. Next year looks like it's going to be just as busy. A lot of activity in the market. I think there's a lot of nuance, which we'll talk about underneath just the deals and the investments and whatnot. And it's good to be back and having one of these episodes because it's, one, fun to talk through what's going on, explain it to those who are listening. And two, it's just a very interesting time as it remains to be an interesting time in this market.
Yeah, I mean, outside of the World Cup draw, which maybe we don't have time to get into today, seems like there's a lot going on in the US, and there's a few stories, updates that we're going to be talking about. The first one being a very interesting move from Siemens. So context, and this is why we've got you here to go into that, but Siemens via Brightly have bought Setmetrics, and Siemens have Siemens are now leaning into or deeper into XOI. And from my standpoint, please dive in here. It doesn't feel like a standard acquisition here. It feels like it's much more like system capture. So first question, before we dive into the details, is this noise or is it genuine structural shift?
So the Brightly acquisition, so both of the deals you referred to, Setmetrics being acquired and then the partnership announced with XOI. One of the big parts of XOI is an acquisition they did maybe a year or so ago called Specifics. And that was, think of it as an asset database, right? You have a nameplate, you have a serial number. We can give you a lot of information on that piece of equipment, which is actually a really big problem in the market. So Brightly did two things, partnership, acquisition, they fit together. Brightly, part of Siemens, obviously a much bigger firm with a lot of capabilities, a lot of services, a lot that they can do, obviously, in the market. I would say that this is, you could point to something I wrote back in 2014 or 2024, I mean, called the rise of enterprise decarbonization analytics solutions. And that's just a new category. Setmetrics, I think, is a piece of that. What Brightly is trying to do with Siemens is a piece of that. It actually kind of maps pretty closely to what I wrote about over a year ago. To your direct question, yes, I don't think it's noise at all. I think there's actually some strategic thought here, without a doubt. But I also think when a company like a Brightly is acquired by Siemens, which was the bigger, I mean, that was, I think, purchase price was $1.2 or so billion. That is clearly going to have different ramifications, right? I don't know that there was one core thesis. We bought Brightly because of one thing. I think actually you could point to a couple of different reasons that they bought Brightly. And so I think that it's been core strategy all along.
Yeah. So let's look at what has actually been bought. Can you break down what Brightly do, what Setmetrics do? And most who listen to this show, at least, will know about Siemens, but break that down just as well.
So, I mean, Siemens, like all of its OEM peers, most of their business, I mean, Siemens is a little bit different because really they have, it's a lot of different business units. But if we go to building automation as all that really matters for our purposes, Siemens looks a lot like a lot of their peers, Johnson Controls, Honeywell, Schneider. They have a lot of hardware they sell, and they have a lot of services they sell. And the services are from, we can install controls in buildings. If they had HVAC, they could also do the same with HVAC. We can maintain them over time through service contracts. And then we also have a lot of capabilities to upgrade and retrofit your buildings in the long term, or over the life of the building. The software piece, in most cases, there are real software products there, but a lot of cases, those software products are bundled in with the hardware, bundled in with the services that are being provided. So they're not exactly a SaaS or a software company in that we're selling you software licenses. All of them, including Siemens, have been really working to change that through developing our own software products. We have a timeline in our newsletter where we track the cloud-based offerings that all of them now offer. They've also been focused on acquisitions to buy software. So when Brightly was acquired, JCI made a similar deal for FM Systems, Trane made a similar deal for Nuvolo, and a little bit later, Schneider upped its investment in Planon to 90%. They had already owned a share of it. So they're all buying. So you could argue, one, they want more software because there's a lot of advantages to selling software. Software also is sticky to the building, right? It gives you a lot of information that you can then use to sell more services, upgrade hardware. So that makes sense too. But Brightly in particular, it's really a core asset management and facility management product. They had grown through some acquisition. They had received significant investment from a private equity firm or multiple private equity firms. So they had grown both in capability and in type of building. But the core of what they do is work order management, asset tracking, just having a lot of those data points and a lot of the systems of record for a facility management team. They started as School Dude, then they became Facility Dude, and now they've rebranded to Brightly. So they have software that is in this talking to the same people that a Siemens rep would be talking to. So there's a lot of overlap in terms of, not only can we sell you the software to track the performance of your staff and the performance of your facilities, but we also can upgrade facilities if they need to be upgraded. We can retrofit and finance those retrofits if there are things that are broken or they're going to break. So Brightly makes a lot of sense, just like those other acquisitions make a lot of sense. The Setmetrics piece. So first, Setmetrics based in Australia, very small, I think 10 to 15 employees. They'd been around for a couple of years. I know they were readers of the newsletter. So they've reached out to say hi in the past. They called it an energy twin, but the way I would describe it, digital twin is a bit of an amorphous term still. Modeling energy consumption and performance of individual assets is kind of the core there, right? So we have a chiller. We can track a lot of data off the chiller, but that doesn't necessarily tell us what will happen in the future. That doesn't really allow us to do any type of scenario modeling. And that's the core capability that Setmetrics brought to the table. So why does that matter? Well, if you know, as Brightly, what equipment is in all the buildings, if you have energy management, which they also have an energy management capability within Brightly, they had bought a company in Canada called Energy Profiles Limited. They also had their own energy management capabilities. So we know the energy consumption over time in the past. We also have this large organization, Siemens, that has the capability to repair things, to fix things, to upgrade and finance retrofits. Well, what if we then can also model into the future based on your building, based on the work orders that have been filed, based on energy consumption of different assets, based on our knowledge now through the partnership with XOI, for any missing data in your CMMS or your asset management solution of, we know we have a old chiller from this OEM, it's 10 years old, but we don't really know, it was all on paper, all the details. We don't have any of that anymore. Well, they can pull that in. Setmetrics is kind of that piece that I think gives them more visibility moving forward into, well, does it make sense to retrofit this? Should we keep fixing it? There's a lot of decisions that a facility team need to make of, we have a capital plan. We know how much we think we have to spend in the next 10 years, but oftentimes that's just based on ages, right? This is old. This isn't as old. This is even younger. Okay, we're going to have to spend the money to replace them at times, just based on this piece of equipment should last 10 years. So they don't necessarily have to do that or only that moving forward. If this all works together, as I think their hope is for it to all work together. So it makes sense. And it definitely fits in with something I wrote in that piece from 2024 of, you think of this as capital planning with a net zero or a decarbonization lens. You could say it's also energy efficiency, right? Because if you're reducing energy, you're reducing carbon. But it's not just replace this piece and put it in the capital plan because it's going to be too old. It's actually performance-based. Condition-based is another term that you could use. And I think that's where they're aiming for with this acquisition.
So just to be super clear for the listeners, from your standpoint, with this acquisition, what control layer is Siemens trying to really buy into here?
I think that they're, one, trying to differentiate the core CMMS software, because still, if you look, a work order management or a computerized maintenance management software solution is table stakes for a lot of large, if you have 10 or more employees on the facilities team, a handful of buildings, you probably need a CMMS to just manage your work. But a lot of that is task management, workflow management. And those solutions are fairly similar, right? There's incumbents in different industries. So you look at, well, how do we differentiate that? And also, how do we take that core CMMS capability, which is typically bought at a portfolio level, and align it a little bit more closely with what Siemens brings to the table, knowledge of how buildings work, staff, trucks, labor that can go fix the buildings, and then obviously the ability to retrofit them. This is connecting those two dots between CMMS and building management services. I think more than an average CMMS would be able to do.
Okay. Well, there's another topic we're going to dive into, which is CMMS focus, but let's stick on the theme with OEMs. And when we've done these shows before, these market updates, which again I personally love doing, there tends to be some level of ambiguity around the data, right? Like if you think about when we do investment shows or fundraising shows, it's really hard to understand what the structure looks like there, or if a company's being acquired, what the numbers look like, which I imagine would be quite an interesting talk track for, or just to view for anyone that's like us that wants to learn about the latest and greatest or what's new in the market. But the other thing is understanding how much these big incumbents, the OEMs, are actually scaling their digital services. And you built a tracking tool or a tool around OEMs and the digital scale. So can you talk us a little bit through what that looks like? And we'll share this on screen for those who are watching on YouTube.
Yeah. So what we've done is part of the newsletter. It's not a tool as much as it's a centralized place to track scale of the different incumbents, the larger OEMs, and their digital services solutions, and what numbers are they putting around that. It's something that, let's say, every 3 to 6 months, our plan is to update it and just put it in the newsletter and update. And just so the one that we published was in October, so 2 months old. But what's interesting, and maybe a little bit of the context here, if you actually know where to look, and that's mostly just listening to earnings calls, looking at quarterly or investor day type decks, not all of these firms, but over time, typically most of them are talking about, well, how much scale do we have? Now, the challenge is there's no standard metric being used, right? When I did the capital efficiency research under a year ago, we were able to figure out, well, most companies talk about square feet deployed, millions of square feet, right? When you look at the OEMs, they're not always giving you that exact number. Sometimes it's assets, sometimes it's data points, sometimes it's, how many streaming data points in total, right? So you think a chiller might be reporting metrics every 15 minutes, energy meter 15 minutes, might be every 5 minutes, might be every 1 minute. So like the more granular the data, the more numbers, the higher that number becomes. But my thinking here was just, we should have some place to go to just understand what are they saying. And different OEMs are more or less inclined to talk about this. I would also say it's not something they consistently report. Maybe there's some exceptions there, but they're at least with some regularity saying the digital strategy is very important to us, and here's how we're tracking our progress in that digital strategy. So connected buildings is a common number. Connected assets is a common number. Sometimes number of clients overall is a common number. But what we've done in the newsletter is we're laying out, if they give a metric of just how much revenue, that's pretty rare. But how many buildings, how many customers, how many connected devices. And so the leaderboard itself has whatever core metric they're using, or maybe multiple metrics they're using, and then also some details and commentary. What are they saying about this? From actual quotes from actual earnings calls, which are public. It's just they're kind of long, and one of the value props I'm trying to bring, especially to newsletter subscribers, is, hey, you don't have to go listen to 10 earnings calls. We're going to take care of that for you, and we're going to pull out the things you need to know about that.
But before we dive into the details and your commentary on that, is there a core metric that, from your standpoint, you've obviously spent so many years in the space and come in from an analyst view, or with your analyst hat on, is there a core metric that you see where you're like, oh, okay, well, this company is doing pretty well outside of just revenue?
Yeah, I think that, revenue numbers are tricky again, because usually these are small enough business units. Within all these companies are tens of billions in revenue. So if it's even, think of our industry, if you're making $50 million a year, that's really good. That's probably at the upper end of the size of smart building innovators. But for a company that's making 15, 20 billion in revenue a year, that's not that much. So it's probably not something they're going to pull out, maybe a percentage of growth. So anyway, to your direct question, though, I think number of buildings connected is oftentimes an interesting one. I also think number of assets, but honestly, asset is a little bit nebulous, right? Is that every field controller is being monitored?
What does that mean?
Because, what does that actually mean? So I like either number of buildings connected, or if it's a specific asset. I'll give you two examples. So Carrier pretty consistently now is talking about how many chillers have been deployed and what percentage have a service or have a service contract on them. And they talk a lot about the service being digitally enabled. So on one hand, having a service contract on a chiller could be a very traditional, we come and check your chiller every quarter, every 6 months. We have a certain number of hours to repair things if something goes wrong. The digital enablement piece, obviously remotely monitoring, that's interesting, right? Like that's a real number. And you can actually track that a little bit over time, because maybe not every 3 months, but at least every 6 months, they're reporting the number of chillers is going up because a lot of data centers are deploying a lot of chillers, but the number of that are attached, the attachment rate is the term they use, it's going up as well. So that's interesting. Trane talks a lot about connected buildings. Part of that is the acquisition they did of BrainBox that brought them 15, 20,000 buildings. They had a lot of other connected buildings. They have some other products out there, but they're talking about that number. Again, we're never getting to the level of detail where anyone is reporting we have an energy monitoring solution. You think of like the Lawrence Berkeley National Lab framework of you have energy monitoring software, you have fault detection software, you have automated system optimization software as three core categories. There are more, but those are three really good ones. No one is out there reporting we have this many fault detection buildings, this many energy management or energy dashboard buildings in general. So so it's still not complete visibility, but it's interesting metrics. And I think over time, we'll see some of those trends. Who's growing a lot, who's not growing, who's reporting a lot more detail, who's pulling back on the detail they're reporting, will be an interesting story to tell as we do this more versions in the future.
And just for the benefit of people listening who haven't seen the graphic here, so if we think about the top six or the six that you've put in here, Johnson Controls, Siemens, Schneider Electric, Honeywell, Trane, Carrier, and also Acuity.
Acuity, I put so.
Yeah.
7.
From your standpoint, with the research you've done, is there which of those companies are you thinking, wow, they're performing well in 2025 based on our data?
Yeah. So I think year to year, the annual performance, I don't know that there's a huge amount of change. I think over the long term, that becomes a little bit clearer. I think the numbers would indicate that Carrier is certainly growing quite a bit, growing its digital offerings, growing its digital offerings, growing its deployment of chillers. They never had as much scale historically as a Trane or a Johnson Controls with the York chiller business. So those were always the two biggest. So they're catching up. I think Trane, I found, is pretty vocal about their digital strategy, which is beyond just we have this many connected buildings. They're going into a little bit more detail. A lot of that is on the back of the BrainBox acquisition. And then I would also point to Schneider, which actually, if you look at the data, Schneider isn't as detailed about this is how many buildings we have, this is how many assets we have. I mean, they do have some data. The one number I was able to pull out was 100,000 commercial building software users. So again, the seat licenses, we know that most of these businesses, big and small businesses, aren't necessarily selling seat licenses. That's it. A CRM, a CMMS, they might sell seat licenses, but if it's a building analytics product, they're probably selling it based on number of buildings, square foot of the building, maybe modules. Like you buy more modules to get more capability, but it's not per person, it's per building. So that's still a useful number. But they also have been pretty consistent. EcoStruxure is probably the longest standing platform. Whereas some of the other firms, and I have this in the cloud building OEM tracker, the fact that other companies have launched a product and kind of pulled back and launched a different product and pulled back, whereas Schneider has been fairly consistent over the past 10 to 12 years. That's been their platform. They've improved it. They've enhanced it. So I think those are a few that I would pull out, but at the same time, they all have something positive. JCI bought FM Systems.
Yep.
Not exactly a smart building platform, but still a pretty scaled, pretty fast growing workplace and facility management platform. So they all have a positive story. And I think the point of the leaderboard was not so much to figure out like who's winning and who's losing, as much as it's just to kind of ground things in actual data.
Yeah, no,
based on
it's good
public sources that are just maybe harder to find.
It's really good visibility, and even for me, and I'm obviously not building a tech startup or deploying either OEM technology or new technology. So I imagine a lot of listeners here will resonate here, especially and also within your newsletter. But from if we think about it from a competitive landscape, at least from what I'm seeing. Let me take a step back. When we have conversations in the space, you tend to have views which paint OEMs in a relatively negative light. Like the digital services, the technology adoption or the innovation just isn't there. However, when you look at the metrics on this OEM digital leaderboard and just the notes that you've written, it clearly is there. Whether it's via their main business or whether it's via acquisition, there is progress that they're making. So from a company who is trying to be innovative and really shake up the market, like do you see this leaderboard as sorry, let me rephrase. I'll have to cut this bit out.
It's okay.
So do you see this leaderboard and the data here, if you're a tech founder and think this is healthy competition, like you're able to see the data, or do you see it as a threat? Like they're seeing the true scale they're up against?
I think it's a great question. The motivation for me, so one, there are a lot of smaller or mid-stage companies that I work with. So our firm can help in a variety of ways. One can be, I want to develop a robust partnership strategy because I think I can bring something unique to the table. What's interesting is, to go back to the Train Brainbox piece, Train had been partnering with Brainbox and then they bought them. Now, there are other examples of this as well, where you partner with a company and then you buy them. That is not a crazy strategy, right? Like that's actually a pretty thoughtful strategy. So if you're a smaller company, you might come to our firm and say, Joe, I need to figure out who I should be partnering with, how I should be partnering with them. And this is really much, there was much more depth that would go into an engagement like that. But in this case, just knowing like who's really scaling, who's not, who's really focused on connecting to chillers. Okay, well, we have an automated system optimization solution. So the company that has a lot of connected chillers is probably a better partner for us than the company that doesn't have as many chillers. So it's not going to tell the full story, but I think it is a bit of a benchmark, if you will, to determine like how should we be looking at these companies. I would also say these are large enough firms that they have a lot of different business units, a lot of different people, a lot of different ways to go to market. So as a startup, I wouldn't look at this and say, oh, we should be really, really threatened by this company or that company. I mean, there's examples on that list of companies that are, if you went and talked to them, that are partnering with some of those startups that we know are out in the market, the vibrant kind of innovative companies. So there's already partnerships happening that are driving some of these numbers. But I think the other one, as a startup, it is useful to see how much scale do these larger incumbents have? Because at the end of the day, they're not going away. Maybe they pull back a little bit on the digital strategy. Maybe they invest more in the digital strategy. Maybe they realize our digital strategy hasn't been working as we'd like. Let's go buy a company to really accelerate things. Those are decisions that individual OEMs are going to have to make based on what they see internally and what they see on the field. But I also think that the innovative startups should be thinking the same way. And some of them are pretty vocal about how much scale do they have. So being able to compare, well, how much scale do we have compared to, one of the big incumbents, I think is just a useful number or useful numbers to keep in mind.
Okay, got it. Appreciate the context. So if we change gears, go back to CMMS, let's look at the relationship between ECOTRAK, which is traditionally a CMMS across multi-site retail, dive into the details there, and ENTOUCH Controls, which we've spoken about previously. They raised, I think, $50 million a couple of months ago, energy management software. Talk us through some of the updates there and the relationship between both companies.
Yeah. So I think a key point to make about work order and CMMS software is that there's a lot of these companies. So it's fragmented like smart building tech, controls tech, energy management tech and buildings. But you do have a little bit more of a ability to point to scaled players versus, innovative disruptors. Whereas in our market, I think there's a lot of companies still trying to scale. But you also have, like our market, a lot of breakdown by type of building, type of industry, and other just kind of dynamics. So ECOTRAK is a CMMS, is a facility management solution that's really focused on multi-site. When we say multi-site, we typically mean small commercial buildings, but where you're selling to an organization that has a lot of very similar small commercial buildings. Restaurant, retail, bank branches you could put into this bucket. Even convenience stores would probably fit in, but they typically, couple dynamics. One, you as the ownership organization, and maybe it's franchisees, maybe you own them, you have individual buildings that are not that complicated. Maybe you have rooftop units and thermostats, and that's it. If you add them all up, though, there's a lot of energy spend, there's a lot of facility spend, there's a lot of cost. So it's hard to send somebody or have somebody permanently in every building because it might be a 3,000 square foot store. You might just have one. You go into a convenience store, there's just one person working there, maybe two. You don't have a facility manager. So that is, and there's a number of companies that make software for that multi-site for facility management. Some of them bundle in the actual marketplace. So, it's snowing, I need snow removal. I can just go online, request snow removal, and somebody in that marketplace will come and do it, and all the invoicing is handled. So you have that side of it. And then on the ENTOUCH side, I would describe it as a simple controls offering, really targeted at those sites that check the box on control the HVAC, maybe control lighting as well, if you want to go that to lighting as well.
And they've been around a while as well.
The enterprise, yeah. Sorry,
they've been around a while as well, haven't they?
Yeah, and there's a number of the companies like an ENTOUCH that have been around for 10 plus years. So there are some newer entrants out there, but there's also a lot of legacy players. And the OEMs, some of them actually play here. So Siemens, I think even 15, 20 years ago, bought a company called Site Controls. Before that, Honeywell bought a company called Novar, which had a few different business units, but one of them was this multi-site energy management controls product packaged together, right? We'll help you with the control in those sites, but we also can give you some energy monitoring data along with it. So it's a real market. I'm actually finishing up for the newsletter a piece. It'll probably be out by the time this goes live, but unpacking small commercial buildings, because it is its own ecosystem. I would describe different types of technology. You don't need a full control system, different players, different dynamics. But all that said, just as we talked earlier about Siemens and Brightly trying to bring together running a building, the system of record, the CMMS on one side, with the actual ability to affect change in the building, that's what I see happening with ECOTRAK and ENTOUCH. So just to kind of what is happening after that very long prologue. So Respita Capital had acquired ECOTRAK, and they recently announced they invested in ENTOUCH, and that was fall this year. So it was recently. Now, what I noticed actually last week or the week prior, there was a press release where they described the ENTOUCH deal as an acquisition, not just investment. So you could argue that they have likely a majority share, at least, in ENTOUCH. ENTOUCH and ECOTRAK fit together pretty nicely. And those are actually the only two public investments that Respita has made. So it looks like, to me, as somebody just kind of analyzing the market, they go together very similarly to all these other CMMS plus energy management plays, right? JCI buying FM Systems, Trane buying Nuvolo, Siemens with Brightly. And then you could even look at MRI software, made an acquisition a couple years ago. We have kind of a tracker on just where CMMS plus energy, building automation, smart buildings are coming together. And there's been a few notable deals there. Spacewell, based in Europe, they bought a company called Dexma, small Spanish energy management solution. You probably know more about them just because they're in your neck of the woods. But there's been a number of these deals, and this one seems similar. This is one of the only ones I've seen, though, that's really focused on that small commercial building type.
So if we zoom out, why would and if we think about CMMS, and I think if we're right in terms of the relationship with ECOTRAK and ENTOUCH, working very closely together, I think it's a very smart play. From just before we move on, why would you say this layer CMMS, a company like ENTOUCH, they win so consistently? I appreciate it's in mid or small commercial buildings, but if you think about the broader tech vendor landscape that we know, smart building tech, let's think broad, these guys seem like they have more success than some of the other players.
Yeah, so I think that small commercial building controls market, it's a little bit less fragmented. You probably have 10, 15 scale players. You have some that are part of like a Honeywell or a Siemens, and you have some that are like an ENTOUCH that have scaled on their own. So that makes it a little bit easier to select. The way they sell is in many cases as a replacement to a standard thermostat, right? So you think of we're selling analytics to a building. That's on top of your building automation system. That's not instead of your building automation system. You could argue when you go to a chain of restaurants, they're typically going in and saying, we have a thermostat, or you can buy a thermostat and we can connect to it. But what we're giving you is a supervisory layer that is more effective, but is kind of part of that core. You have to have a thermostat in your building, right? If it's a restaurant, retail, they're not just going to say, oh yeah, we don't need air conditioning here, right? Like they're going to need it, and they're going to need a thermostat. So it's a little bit more aligned and within the same buying decision as what you know they're going to buy. The CMMS side, I think it's similar, right? The CMMS products have been around long enough that it's really just become table stakes, a required purchase to make, just as you put HVAC in your buildings, right? You wouldn't just say, oh, we don't need air conditioning here, unless maybe you're in the mountains in Colorado, right, where you actually just don't need air conditioning, but you still need heating. So the CMMS product is much like your organization. You sell things, you're buying a CRM. You are a publicly traded company, you're buying an ERP. That's where CMMS lives. And I don't think a lot of smart building tech has gotten to that level where, of course, we're buying this. It's just it's just a standard part of our operating procedure. So that's where CMMS has been able to scale. And then joining them together, I think, makes sense. I've certainly heard from talking to folks as part of client engagements, or just talking to folks in the market, just for my own knowledge, that have pros and cons of why do these go together, why do they not go together. So I don't know that everyone 5 years from now will be buying a combined energy management and CMMS product, but I think that it's likely there are more doing it in the future than less.
Understood. So let's talk about a trend that you've been seeing. And I'll hold my hands up. Don't do a lot in resi. Don't know enough about the resi market, but you've been seeing something particularly interesting. So talk us through.
I think I'll just, it's a bit of a quick one. I'm bringing it up because, the number units of residential HVAC unit sales are down this year about 30%. I think we're probably bottoming based on just what I've been able to read. And this isn't my data, right? This is just, you can go Google residential HVAC sales. A lot of reasons for that, right? People aren't moving as much. Houses aren't being sold as much. I think there's less building of new houses because there's more supply and there's fewer people buying. So obviously those things are going to contribute to a reduction in just number of HVAC units for resi being sold. Where this is interesting is, one, it's useful to know because look at some of the biggest companies in our market. They are also very big on the resi side. JCI just split its resi light commercial from its commercial business, and they sold the resi light commercial to Bosch. But other than that, Trane, Carrier, very, very big players. And the balance you're seeing, if you look at top line, how are they doing? They're all doing really well, but there's this commercial HVAC's doing extremely well because of data centers and reindustrialization in general. Resi HVAC doing pretty poorly, and it's kind of canceling each other out. But the interesting piece there is, I think, just when you have a business that is very exposed in both commercial and residential, having that much of a drop in resi sales is just going to have an impact across the entire business. From we're not making as much money as we thought we were going to make. We're not necessarily going to invest in as much in kind of risk focused deals. Though they're still very heavily focused on data centers in particular. So So that's the point. It's more of an FYI, useful to know about, something that I picked up a couple months ago and put in the newsletter.
Yeah, and speaking of FYIs, the Deloitte Real Estate AI survey, which I was sent a few times, anything notable from that?
Yeah, there were a few things that caught my eye. So they do, it's called the Real Estate Outlook, and it's the 2026 one came out in the past month. So they publish it right before the new year, but they do some survey data of actual real estate. And it's not smart building specific, right? It's real estate, but it has a big technology component. So they were talking about adoption of AI, and it was really focused, I would say, more on commercial real estate as a subset of real estate in general. But the one graphic, it was figure 9. I think we can show it. It's in my newsletter as well. They were just going through what did you think about AI adoption in 2025, and let's map that to 2026. And it was basically just where the direct question was, how would you classify or categorize your current AI position? And it was from, we have no interest, we're in an early experimental phase, all the way up to we're seeing some incremental benefit, or it's transformational. So if you look at those numbers, what was reported by this cohort in the survey in 25 and then in 26, or for the 25 survey and then for the 26 survey, there was a big increase in people who said, we're still experimenting, we're having some challenges with implementation. There was a big jump in challenges with implementation as an answer. And then there was quite a big reduction in the incremental operational improvements and then the transformational impact. And just to put some actual numbers on it, just looking at the data, in the 2025 survey, 12% of respondents said AI is having a transformational impact. This current survey that just came out last month for 26, 1%. So huge drop in people who said this is having a transformational impact. You also look on the other side, 16% of respondents in the 25 survey said we're having challenges with implementation. That has jumped to 27%. So it hasn't doubled, but it's gotten pretty close. So I think that gives you it's one question on one survey, but it gives you a good sense of where are we at. And that's not so different. I think if you looked at any industry, they'd probably have similar things to say. We thought it was going to have a lot of transformational impact. We started trying and we realized, wait, it's really hard for us to implement. It's really hard for us to unpack the data. So,
and also just on that, I think the value's there, and implementation's an issue, right? But who gets the value? Because if you think about it, if you use Deloitte or one of the big consulting firms, for example, them implementing AI, it doesn't necessarily benefit the customer. It tends to benefit Deloitte or any of them. The benefits aren't getting passed on to the customer, and the benefits would be better profits, potentially cheaper, and maybe that translates into our industry where you think about AI or products that are being called AI. It's like, well, what is the benefit to the end user? Because at least from where I sit and the individuals that I've spoken to, the value tends to stay stored with the people, like the founders or the technology vendors using it internally versus as when it's getting deployed. Yeah.
So I think the best answer I can give you, there's a lot to unpack, but
it's an episode's worth.
It's an episode's worth, but I'll answer it now. And I think it also actually touches into 2026 predictions, which we're going to do an episode on that too. But I think there's a bit of a challenge in maybe all industries, but I can speak with expert opinion on our industry where there's value from AI because we use AI every day. It saves us time. It allows us to get to an answer or get to an outcome faster. Maybe in certain ways we can do a better job, right? Think of massive amounts of data we're trying to compile in a spreadsheet. We can do that much more quickly, and it's going to be a more effective outcome. I use AI tools if I've interviewed, let's say, as an example, 15 people for a voice of customer study, I'm not letting AI draft deliverables, but I might query AI with all of that information. Say, I remember somebody was saying this and somebody else said that. And, you can very quickly query all of this information and then start drawing conclusions more quickly. And I would argue I'm probably catching things, finding things that were in the notes I took, but maybe it was the first interview I did, not the last interview, that I now know. And I can, so there's this tool or these tools have a lot of value. But I think a challenge that we have right now, especially in our industry, is We know there's a lot of value, and we know we have problems, right? We know that when we go into a building that has a 10-year-old building automation system, point tagging is probably all over the place. Even getting data about the current state of equipment, like how old is this piece of equipment, or how often have you been repairing this equipment? Oh, it's on a clipboard, right? Like, okay, well, I'm just like, it's 10 pages. I'm going to go review them manually. Like, no, maybe you take photos, you upload them, you get it all to kind of be compiled in a more standardized way. So there's huge value, but I think we're not necessarily connecting those two things, right? So it's like AI will save you time, AI will reduce energy in buildings, like, and it's not that isn't valuable to the building owner. It's just there's not as much of a direct line. A lot of when I go to conferences, a lot of AI is still kind of spoken of as nebulous, right? Like, we're saying we're AI powered because everyone's saying they're AI powered, but like, what does that really mean? You talk to building owners and operators, and they say, really, I want to know how you solve my problem.
Yeah.
I want to know how you do it differently. I want to know how your value is outsized value compared to peers. If that's AI, great. If it's not AI, great. I'm still getting a lot of value. So I think that's where we're at. I think where we might be going more tactically, to your question about like, where is the value? There is a thesis, I've been hearing this more and more, that a lot of the tech we talk about in smart buildings, the best place for it is the people who are going into the building, who are managing and providing service to the building. They use it to make their offering better and to deliver it more effectively, as opposed to, we're going to go to the building owner and sell them something that's an additional budget line item, an additional capability that they'll then use kind of in concert with the service providers. I don't know where I land yet on that, because I can argue it both ways, but you could note that it might be you're still buying the same things you've always bought from the same vendors. It's just they're now using AI to make it a much better offering. I will tell you that hasn't been a go-to market approach for a lot of the innovators that are in our market thus far. Not all, but in general, that is not something you're seeing very often.
Okay. Let's wrap up with a couple of quick-fire questions I'm going to throw over to you.
Sure.
So, what are you choosing, open or closed products?
I think open in general. I definitely have seen some interesting products that are closed, or some things that are enough of a point solution, and I definitely don't mean that in a negative way. Just like they can kind of sit alone, that you could argue it is closed, but it solves the problem it needs to solve. But I generally would go with the open products.
Open's good. Best value, energy analytics or asset intelligence?
So a year or two ago, I would have probably been more bullish on asset intelligence, but honestly, and this is another 2026 prediction, energy costs are going up. Energy, the challenge we always had with energy, to be very long-winded about the rapid fire question, but the challenge with energy was that while there's always a lot of opportunity to save energy in buildings, right? 40-45% of energy is wasted. Well, maybe less is wasted, but that's the amount from HVAC systems, and of that, a good chunk of it is wasted. So there's a huge opportunity to save. A lot of people would say, well, but my energy spend is about the same as it is every year, and I'd rather just keep it consistent than, push to save energy and then set the expectation that I'm going to keep saving energy. Now energy costs are going up. So treading water, if you will, means you will spend more and more every year. So that will then, I think, lead to the question of, well, how do we avoid spending more and more every year? Well, you have to spend more time saving. So I actually feel like this might be another golden age for energy management software. All that said, there's a dearth of knowledge about individual assets. And I think that's probably that has a longer room to run, because, everyone is talking about energy costs going up, right? So you as a building owner will have to do something about it, but you may be able to solve to some degree that problem in the next year. I think you're still going to have an issue with asset intelligence.
Okay. Firstly, phenomenal answer. Not quite the quick fire we're looking for, but we'll do some work.
Try, man.
Final one. Technology adoption over the next 5 years. Which has more success, multi-site retail or commercial real estate?
I actually, you could argue, I haven't dug into the numbers to compare both of these as much as I should. But
Just
I think
a quick fire, Joe.
I know we're getting no. You can bust my chops anytime. I actually think commercial real estate had struggled for a few years, and I think they're getting back to stable footing. More broadly, if you look macro commercial real estate, So I tend to think that potentially has a little bit more room to run. I also think because it's more fragmented, you as a new company might be able to execute on a wedge strategy to get into a couple buildings and use that to land and expand. Whereas the flip side, it may be harder to enter into multi-site. However, I think you could succeed in both.
I'm so bullish on multi-site right now. I just think it's such a... I mean, it's a well-trodden market, but it's still so untapped. And there's just a lot of work that can be done there. And I imagine tying into... I mean, I have no affiliation to ENTOUCH, first and foremost. But companies like ENTOUCH in that market, I just think it's such a sweet spot.
Yeah, the thing I'm actually... So I noted I'm publishing kind of a deep dive on that market, and I've done some of the initial analysis, but not all of it yet. So if we recorded this in 3 days, I'd probably have a more robust answer, and I might be more bullish like you are. All that said, I think that the topic that you often hear, and the reason I started digging into this is because we talk about like the 90% or so of buildings that don't have a control system, and almost all of them are small. But you could also say 30% of commercial buildings, give or take a little bit more than 30, don't actually heat their space. And if they don't heat, they definitely don't cool. But it's like 40% for don't cool. You don't need controls if you're not heating your space. And if you think like, that sounds weird, what buildings are those? Warehouses, a lot of them are not conditioned. There's a lot of service buildings, right? Like garages, car washes. There's actually almost no interior space in them. And if there is, if you go to like an old garage, not like your car dealer, but just like an old garage, there's all kinds of other repair type shops. And if you actually add up the numbers, that's a huge number of buildings. They're all really small. They're all pretty insignificant. But they don't have controls. Maybe they have a little, almost like they just bought an old split system, or even they could put like a PTAC into or a window unit just for like the little office. Still no controls. It's an air conditioning unit. So my point being, there's a lot of those buildings that aren't nearly as good of an opportunity. But if you flip it around, it's a much more, the buyers are very consolidated in comparison to commercial real estate, right? Like you could go to the largest restaurant chain, I think would be McDonald's, maybe Subway. That's actually a significant chunk of all of the restaurant buildings, whereas the largest owner of office buildings doesn't even have 1 or 2%, or maybe has 1 or 2%. So there are reasons to like that, right? You're dealing with a market where it's clear which touch points you sell to. If they haven't bought something, it's likely they're going to have to buy something. They also might be more interested in upgrading systems from something old that's 20 years old to something new and modern.
Okay, I mean we've unpacked a lot. We've gone into great depths on a lot of things. Joe, as always, appreciate you. Thanks for your insight. If you've been listening, thanks for listening. We will see you on the next one.